Welcome to Bloomberg Markets. I'm Scarlett Fu. Inflation has eased for a fourth straight month, but how's the tamer report moving markets? S&P 500 is higher right now, and because investors had largely priced it in following yesterday's wholesale prices report. We saw stocks initially decline, but you can see it's now up 0.5%. And we have the Nasdaq in large part to thank for it. Mag 7 is pretty mixed at the moment, but the Nasdaq is certainly keeping pace with the broader market. Now, little change in bond yields right now, but definitely more buying at the long end of the curve that is pushing down yields, the 10-year at 3.82%, and the dollar drifting lower by about 0.2%. Let's get you some midday movers on the equity side here. We're going to start with Alphabet. The shares sliding today after Bloomberg News reported that the U.S. Department of Justice is considering a breakup of Google. And of course, this comes after a landmark court ruling found that the company monopolized the online search market. So the stock fell in after hours trading and has extended that decline into today's cash session. Another big mover is Kellanova, up today after Mars officially announced a deal to buy the company for almost $36 billion, bringing together two major food companies in what has been described as the biggest deal of the year. The price, by the way, represents a 33% premium over Kellanova's closing price on August 2nd, the last day before the talks were initially reported. Now, outside of individual company names, of course, the big headliner is the U.S. CPI report. Here's David Kelly from JPMorgan Asset Management from earlier today with his take on the latest read on inflation.
I think it's pretty good news in the actual transactions markets of the economy, where people are sort of bidding and asking for in terms of prices. Inflation is disappearing. So I think that overall, this very much confirms the idea that inflation is heading down.
So to continue this discussion, let's bring in Kelsey Berro. She is fixed income portfolio manager at JPMorgan Investment Management. Kelsey, good to speak with you. Give us your overall read on inflation, the picture following today's CPI release and yesterday's PPI release.
Right. So I think in general, the inflation genie is back in the bottle at this point. And I feel like that is really the key message that I would want to get across. So when I think about where is inflation still above trend, it's really just concentrated to two primary categories. That is shelter and auto insurance. You know, outside that, there actually isn't that much inflation. Things have really returned back to normal. So, for example, if you look at core CPI excluding shelter, month over month, it's been negative for the last 3 months in a row. So I think this is definitely the inflation report that the Fed is looking for. And essentially what this does, it removes the tail risk of inflation reaccelerating and allows the Fed to have quite a lot of flexibility as it relates to responding to any downside risks to growth or labor markets.
So if we take a step back for a moment here, because I just want to understand how we got here. The disinflation story has definitely evolved over the past year. Before it was goods-based, now it's more services-based. Is that how it's supposed to unfold?
Well, I think it makes sense that that's the way it's unfolded because the low-hanging fruit was the goods inflation. That was related to the supply chains. Right. The tougher inflation to take down has been the services. And so I think the Fed should feel more confident with the inflation that we've received in the last 3 months than the inflation we received in the last 3 months of 2023. Because it is more broad-based disinflation than it was back then.
You mentioned shelter and auto insurance. Those are the sticky parts in terms of categories that are still showing elevated pricing. What would lower rates from the Fed do for those two categories?
So the things that are driving those two categories, the auto insurance, they're both essentially lagged categories. So if you look at where they are right now, it's telling you about where those markets were 12 months ago. So it's not really particularly helpful from a forward-looking perspective, which is why I think the Fed should be comfortable starting the easing cycle, despite the fact that those categories on a year-over-year basis are still elevated.
Have they run their course, though? I mean, if it's a lagging indicator, do they still have more room to go up?
They still have more room to come down at this point, right? Okay. So they're starting to decelerate, but they still have more room to move lower. So, for example, shelter, it's come down about 300 basis points on a year-over-year basis. That could probably still normalize and not not calling for anything materially weaker than we had pre-COVID. But if you look at rental rates are back to where they were pre-COVID in terms of rent growth, around 4 to 5%. That's the type of numbers that we probably should be seeing over time as the data evolves.
Okay, so let's get your take on what you're doing in terms of portfolios. You see a soft landing as the most likely outcome here. How are you positioning for that, and how are you hedging against that, protecting against that possibility?
Right. So right now, the market has kind of two things to contend with. One is the risk of acceleration of inflation. So that's the one where we definitely have been able to bring that probability significantly down. That supports a soft landing narrative. Now, the risk, on the other hand, is that we see more weakness in the labor market. That's what determines not just the start of the cutting cycle, but also if it will be more aggressive going forward. So the things that I'm really watching looking forward, retail sales tomorrow, claims tomorrow, also the earnings from Walmart. These are the indications that we're looking for to determine, are we still in the soft landing or is it something more difficult? Now, how am I adjusting portfolios for that outlook? One thing we find really attractive right now as a hedge against that risk that the landing is harder are curve steepeners. So you've seen the curve steepen as the Fed has approached the start of the easing cycle. The 2s-10s curve, though, is still inverted.
Right. Although briefly, it was uninverted on Monday.
Very briefly, but we should start to see that, fully disinvert.
Okay.
And the aggressive steepening tends to happen, when the labor market is weakening and when you have those more aggressive rate cuts.
So, quick final question for you. Last week's global market meltdown turned bonds into a hedge against risk assets, right? We saw stocks tumble, we saw bond prices rise, pushing yields lower. Is this a regime change where we are back to an inverse relationship between stocks and bonds, or is this temporary?
No, I think we are kind of returning to the more traditional correlations between bonds and equities. So bonds, high quality fixed income, has proven this month to be a good hedge to your risk assets. And the reason that the correlations are shifting back towards diversification working in your portfolio between bonds and equities is because inflation has come back to a more normal range. So if you look at the correlations, the rolling correlations, and you plot them against inflation, once core CPI tends to fall below 3%, that's when the correlations turn right way again.
Okay, so basically inflation needs to cooperate for this 60-40 portfolio to make a lot of sense.
Exactly.
We've been in a higher for longer mode since 2022. Institutional and retail investors have gotten really comfortable just sitting in cash and collecting, some pretty fat yields on that. It'd be a big psychological shift for investors to then change course and add to duration. Do you see them doing so in any kind of meaningful way yet?
Well, we are encouraging them to do so because we don't want, people to be complacent with their money in cash at 5% because that is a temporary rate and you're faced with a lot of reinvestment risk if you do that, which feels good in the moment, but, the environment can shift quickly. We are starting to see that demand for duration pick up. And I think you're seeing it not only, though, in treasuries, but also when you look at credit. Yes. So, for example, this week has been another blockbuster week for supply, and it's been met by a lot of demand. People aren't scared to extend duration as it relates to credit. So I think we are seeing that demand for high-quality fixed income across the board right now. All
right, Kelsey, really appreciate your joining us today. Kelsey Berro is Fixed Income Portfolio Manager at JPMorgan Investment Management. Coming up on Bloomberg Markets, we're going to look closer at that move by Mars to buy Kellanova. It is the largest packaged food deal since Kraft Heinz, but will this drive more consumer brand deals? We're going to discuss all of that next. You can see Kellanova up almost 8%. This is Bloomberg.
We are faced with a challenging U.S. environment, just like many other consumer-facing companies.
We do see some pressure on the consumer's overall financials.
What we see happening more than anything is the lower-income consumers are a little bit stressed.
Consumers have the income they have, and they're making choices in the everyday basket.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
Some C-suite executives speaking to Bloomberg this earnings season on the pressures that consumers are facing in a slowing economy. And it is against that backdrop that Mars is buying snack brand Kellanova for $36 billion, bringing together a pair of major food companies. This deal is set to be the biggest of the year. Joining us for more is Jennifer Bartashis. She is Bloomberg Intelligence Senior Analyst for Retail Staples and Packaged Food. Jennifer, is this a defensive move or an offensive move on Mars's part?
Well, it's really a combination of both. From a defensive perspective, Mars is part of their portfolio that is in snacking is heavily reliant on cocoa. And that is a commodity where prices have been very high and are going to continue to be high for some time. So adding some diversity on the snacking side of the business is definitely a defensive move. From an offensive perspective, this is really going to allow them to expand more quickly, especially into emerging markets, which is an area of great opportunity. And so it really is a combination of the two that helps make this deal make sense.
So tell us a little bit more about that. How does buying Kellanova increase Mars's reach into new markets, perhaps markets that doesn't have any exposure to at the moment, or markets where it has a little bit of a toehold but not much in terms of actual depth?
Right. So Kellanova has actually had some very strong performance results in the last couple of quarters. And those have been driven, especially in Latin America, is an area that has been particularly strong. That's an area where Mars has got a slightly weaker market share. And so the momentum that Kellanova has in Latin America is an example of where there could be some great synergies for Mars. It's also worth mentioning that Kellanova has operations in Africa, especially through distribution. And so there may be an opportunity there to broaden distribution of Mars products in Africa as well.
Yeah, good point, especially with Mars contending with those cocoa prices. Will this deal trigger more consolidation, Jennifer?
Well, when we look at this deal, there are a couple of things. We see that it will help Mars with their market share. We don't think there's going to be a lot of pushback from the FTC in looking at this deal, simply because the portfolios are very diverse. But it does look like it's checking a lot of boxes for both companies.
Okay, checking a lot of boxes for both companies. We talked about the defensive and offensive nature of the deal for Mars. Who are likely buyers and who are likely targets across the food industry right now as we look at possible knock-on effects from this deal going through?
So right now, there's a lot of effort to consolidate into what are considered higher growth areas in the industry. Snacking has been an area where the consumer has held up well. They continue to spend. So everyone is sort of pursuing some opportunities there. And we've seen companies go into snacking more heavily over the past couple of years. So, for example, Hershey, which was traditionally mostly chocolate, now has some salty snack sales as well. In terms of opportunity for future M&A, I would say that there are companies where there are areas where there is weakness and opportunity to then solidify operations through acquisition. So that would be companies like potentially a Beyond Meat, which is in the alternative protein space but has been struggling. Yeah. And that's a category where consumers just haven't been as robustly active. In other areas, anything that is driven by convenience, that's something we heard Kraft Heinz talk a lot about in their earnings call. Consumers are looking for solutions. And so, companies are out on the hunt for things that will help shore up their portfolios to meet those consumer needs.
Well, they're spending on other companies or other brands. That's your traditional M&A. There's also spending on innovation. Do you see any of these food companies spending a lot on innovation in a way that will pay off, that will increase their ROI?
Yeah, most of these companies are increasing their innovation spend this year. Now, it may not be exponentially, but they are increasing their spend. The idea is that right now consumers are hard to tempt into purchases, and that innovation is one way that you can get consumers excited and re-engaged with your brands. They're also increasing their marketing spend because, again, one of the big issues for these companies this year is to increase volume sold. They've lost their ability to really raise prices, and so if they want to sustain top-line growth, that needs to come from higher volumes being sold. And so the combination of innovation, and marketing and promotions are what they're investing in at the moment to try to achieve those results.
Yeah, as they wait for the consumer to come around and for these falling volumes to turn around as well. Jennifer, really appreciate your joining us. Jennifer Bartashis of Bloomberg Intelligence giving us her perspective on what's to come in the food industry. Coming up, there's more M&A developments as cannabis company Tilray Brands brews a deal to expand its growing portfolio. We're going to be speaking with its president and CEO, Irwin Simon, next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. There's quite a bit of buzz around Tilray today. Can't get my words out, and you'll see why as it continues to branch out from cannabis into beverages. It agreed this week to buy 4 craft beer brands from Molson Coors. They are Hop Valley Brewing, Terrapin Beer, Revolver Brewing, and Atwater Brewery. This is a move that further diversifies Tilray's portfolio following last year's acquisition of 8 brands from Anheuser-Busch. I'm pleased to say here now to explain Tilray's larger strategy is CEO and President Irwin Simon, along with Bloomberg Open Interest co-host Matt Miller. So, Irwin, let me just start with you here. Why these 4 craft beer brands? How do they move the needle on your long-term diversification plan?
Hi, Scarlett. Hi, Matt. Nice to see you. Listen, we were started as a cannabis company. We're the largest cannabis company in Canada in recreational medical. And looking for legalization to happen in the U.S. and not see that happen, I knew we had to diversify this company. So what other fun area and what other adjacency was the spirits and beer industry? In 2020, I acquired Sweetwater Brewery, which had a brand called 420. We all know what 420 means. And that was doing about 2.5 million cases. With this acquisition, we'll do about 15 million cases of beer, over 1 million barrels. And why beer? I saw the beer category declining, and I saw an opportunity within craft beer to make beer fun again, to make beer unique. And I saw that there was not a lot of innovation that came out with beer. And with Tilray's beverages, we've come out with, 50, 75 new products over the past year. We've gained lots of distribution. And now we're the 5th largest craft brewer within the U.S. So, and I think, as you think about millennials, you think about, Gen Z, how do we get them to drink beer? And if one day cannabis does legalize in the U.S., hey, THC-infused beer is something that's going to be pretty exciting.
Although maybe difficult to dose, I think there's some issues around THC-infused drinks. And, Irwin, a lot of people in this country have quit drinking beer because they can legally use cannabis, for example, here in New York. And I think 26 states allow for legal cannabis use. Why can't you operate in those states that have legal cannabis dealers?
Well, Matt, great question. Because we're a NASDAQ-traded company, we cannot partake and we cannot sell any cannabis products within the U.S. Now, let me tell you something. I'm watching this election pretty closely, and I think both candidates have come out and talked about, legalization. If, when Biden and Harris got elected 4 years ago, I didn't think I'd be standing here today still talking about legalization or rescheduling. Something's got to happen. To your point, 27 states, it's legal recreational. About 35 states, it's legal from a medical standpoint. So over 75% of the country today has cannabis legalized in their state, but it's not legal, from a federal standpoint. If that happens from a rescheduling, and it's crazy out there today that cannabis is scheduled the same as a heroin and cocaine, and it's not a Schedule 3 and it's Schedule 1. So I think something's going to happen, and Tilray is ready to go. I mean, we're ready to go with drinks. We're ready to go with infused drink.
That scheduling looks like it's about to change. At least it's been recommended now that it's changed. And we've got the Safe Banking Act, written and ready to go. Is Tilray taking part in any kind of push for Congress, for the Senate, in order to pass that Safe Banking Act and allow the financial side, the back office of weed sales in the U.S.?
Listen, we've been a part of it for a long time, and today is one of the largest cannabis growers in the world. We have over 5 million square feet of cannabis grow in Canada, and we have 2 major facilities in Europe. And you saw just recently what happened with Germany in regards to medical cannabis, that every doctor can write a prescription. So yes, but listen, our politicians got to listen to what consumers want, what the voters want today. You know, we pay about $150 million in excise tax in Canada. There's probably $1 billion paid in Canada in excise tax. And that is, if you take the 10 times, there's probably $10 billion of tax dollars being missed here because of cannabis not legalized from a federal standpoint. So ultimately, something will and got to happen. And that will allow us to come out with drinks. That will allow us to sell medical cannabis, as that's what ultimately legalizes here. And that's what, you know, citizens want out there.
Sounds like Matt was asking you how much you spend on lobbying, Matt. That sounded like another way of asking that. Irwin, over the past 3 years, Tilray has expanded.
I'm not going to answer that.
We'll scour through your financial releases. Over the past 3 years, Tilray has expanded into beverage and alcohol in a big way. I was just looking at this, from 5% of revenue in 2021 to 25% now. Cannabis's share of revenue has gone from 39% to 34% over the same period. Distribution is the third leg, and then you also have wellness mixed in there as well. What do you want the breakdown to look like in the next 5 years?
Listen, as I come back and say, and we gave projections this year to between $950 to $1 billion. You know, a few years ago, when I thought legalization could happen in the U.S., I thought we ultimately can be a $3-4 billion business. What I want Tilray to be is a lifestyle company. Recreational cannabis, medical cannabis, beverages, and wellness foods or other wellness products. And a lot will change depending upon legalization. If it doesn't happen, Tilray is well situated today to grow in the U.S. in regards to our beverage businesses. We're not just beer, we're spirits, we're, you know, energy drinks, and we're beer. But again, I think something will happen. And also, I'm pretty excited, you know, we didn't touch on Europe. You know, in regards to rescheduling happened in Germany, the largest, you know, country within Europe, to the 80 million people. From a medical standpoint, and medical cannabis is for sale in about 20 different countries throughout the world, that ultimately in Germany, every doctor today can write a prescription for cannabis, and through a drugstore, you can obtain it. And we have a major grow facility in Portugal and a major grow facility in Germany today that can supply that. So if cannabis was rescheduled in the U.S. with our grow facilities in Canada, we think we could ultimately sell medical cannabis within the U.S. in regards to export it in here with NAFTA.
Irwin, quick question to you. Yes or no, is federal legalization inevitable in 4 years' time?
I think ultimately you're going to get some announcements that will happen from either candidate that is running for president. And I absolutely thought I would not be standing here 4 years ago from the last election not talking about
Irwin,
it. So I think something will happen.
Irwin Simon of Tilray. Welcome to Bloomberg Markets. I'm Scarlett Fu. Let's get you a quick check on where things stand in the financial markets right now. Stocks and bonds, at least on the long end of the yield curve, are higher, although we have seen them pair some of their advances, especially in equities, with the Nasdaq currently lower by about 0.1%. So big tech still kind of the wobbly part of equities here. We have higher bond prices on the long end, so that means lower yields. The 10-year right now at 3.8201%, and the dollar falling about 0.1% to the lowest since March. As for some equity movers here at midday, we're looking at Progressive. The shares are gaining, reporting strong growth and margin performance in its latest earnings report. The insurance company reported premiums earned for July of $6 billion. The shares of Progressive are actually up 85% in the past year. We're also looking at Cardinal Health. The medical products company is up after posting an earnings beat. Revenue rose 12%, almost $60 billion. Cardinal also raising its 2025 profit outlook. Now, when we go back to the big picture, which is, of course, the economy, we spoke with Mona Mahajan earlier today, and she says things are looking up for not just the Fed, but also markets.
We're moving in the right direction when you look at the Fed's dual mandate. Inflation and PCE inflation certainly below their 2024 forecast. And of course, the other side of the dual mandate is what everyone's watching even more closely. Will that labor market hold in? We've seen some softness recently, but thus far on track for a good September 18th FOMC meeting as well.
BMO senior economist Jennifer Lee joins us now. So, Jennifer, we got the kind of inflation report that didn't do much to change the market's wagers on what the Fed is going to do next, which is likely a rate cut. Are you comfortable with what the market is pricing in right now?
Good afternoon, and thanks for having me on the show. And yes, I am, and I'm going to totally date myself right now. When one of the first songs that came in my head when I saw the CPI numbers this morning was this 80s band called Platinum Blonde. They had a song called "Standing in the Dark." At the beginning, there's this woman that says, "Are you sitting comfortably? Then we shall begin, or we will begin." So I feel like Fed Chair Powell is probably quite comfortable with what he's seen. This is like the fourth straight CPI report in a row that has been encouraging, and I think it puts him and the rest of the Fed in a much more comfortable position to start cutting rates in September. And, this is what has been the call for some time now. And I'm very anxious to see what he's going to say at the Jackson Hole Confab and later on this month. But hopefully we hear some confirmation that, that this rate cut will be coming in September.
Yeah, I'm always, by the way, up for any kind of music references, no matter from what era. The upcoming labor market data, though, will be pretty critical in determining the speed and the size of rate cuts. Which specific data points will you be paying the most attention to? Will Jay Powell be paying the most attention to? Is it jobless claims? Is it the August non-farm payroll or the unemployment rate?
Of those three, I'm going to point to the unemployment rate, just given that, it's based off the household survey, and that has shown very little movement, which has been a little bit concerning over the past year. And so, of course, we saw the jobless rate tick higher to 4.3%. Of course, the headline payroll report will also be of interest, just given that it's undergoing always so many revisions in previous months. And so I'm curious to see whether or not we're going to see a bounce back from what we saw in the latest month, which was 114,000. But I think the jobless rate itself and, of course, earnings as well will be top of mind, I think, for the Federal Reserve if they had to pinpoint it to just one or just a couple of components. But, of course, the entire report is always going to be watched very carefully and parsed through for little tidbits on how weak the labor market is becoming or how maybe resilient it still is. Again, we're going to have to see.
Yeah, I mean, I'm sure he's going to include the totality of the data in his Jackson Hole speech when he does speak. I want to get your take on the latest data when it comes to mortgage apps as well. This is a weekly release, and what was surprising was how much it rebounded this past week. Kind of surprising that refinancings jumped 34% to the highest in more than 2 years. We know the 10-year yield dropped, but the Fed hasn't even cut rates. So what does that tell you that there is that much pent-up demand?
I think it's just more an anticipation of what is going to come. Before it's almost like getting in before the cuts. But again, we have to sort of take those weekly numbers with a grain of salt because there can be so much volatility on a week-to-week basis. It could be like weather-related things that could impact it as well. So, but overall, I mean, I think with what we're seeing so far in terms of slower economic growth, the totality of the data, as you point out, has been pointing to that, slower economic momentum, easing inflation, cooler job demand, and all paving the way and giving the Fed the comfort to start cutting rates. And I think, it's not coming a moment too soon. They've been waiting for a while. They're probably being accused of being behind the curve a little bit. But I think this has been a very reasonable time overall, just making sure that inflation is coming back down to target. Now we're seeing labor demand cooling as well. So again, all paves way for that long-awaited cut coming in September.
Yeah, and you mentioned slowing economic momentum. I'm looking at the calendar for data releases for the rest of this week, and we've got another big one tomorrow, and that is retail sales for the month of July. They surprised to the downside the previous month due to the cyber attack on auto dealers. To what extent will the July report show a catch-up spending by car buyers as a result?
We're probably going to see some catch up, just because, again, when something drops so quickly, and for a special factor like that, you're going to see some rebound in the coming months. But I think it's more looking at not just the headline, and you try to stay away from the headline because there's so much, again, volatility that could go with it. It's more like looking at what consumers were spending on, especially on discretionary items. And that sort of gives them an idea of how comfortable consumers are to continue spending and how their own economic situation is. If they continue to buy more recreational goods and services or spend more in that category, and which they have been doing, it's, again, points to still confidence within the U.S. consumer that they will continue to spend, and that they are still comfortable with their job situation. But in terms of like dining out, that's another one I love looking at. That's been showing a little bit more of a decline lately. Some weaker numbers coming from that component. So it's almost like offsetting. But overall, as long as they're still spending on discretionary items like the recreational goods and services or recreational vehicles, for example, I think it still gives us a lot more confidence in the U.S. consumer going forward.
So, Jennifer, we started with the Fed. I want to end with the Fed. In retrospect, what was the freak out over the emergency rate cut that was priced in last Monday? I ask because I wonder how easy it is for that to flare up again.
I was wondering that myself, because I looked at the markets. I'm like, what the heck is going on here? What did I miss? But I think it was a combination of number of factors. We had one tech company, that was announcing big layoffs, or a couple of tech companies that are announcing big layoffs and missing earnings results. Of course, the Bank of Japan and the rate hike, which shouldn't have been too much of a shock. I guess it was more like the size of the increase came as a shock, and then you saw the subsequent rebound in the yen, which of course has retraced some of those gains since then. And interestingly, I'm thinking that perhaps when the Fed chair was sounding a bit more dovish at the last FOMC meeting, maybe freaked out people because they're thinking, what does he know that we don't know? And maybe it seems like the economy is coming to a grinding halt. But this is what we've been waiting for him to sound more confident that he is going to cut rates, and he's finally saying it. And again, I was a bit surprised that the market had that bit of an overreaction. But you never know. I mean, it's thin markets as well with the summertime, so anything could happen that could cause markets to flare up or down again.
All right, so perhaps the freak out period is not yet over. BMO senior economist Jennifer Lee, thank you so much. Coming up on Bloomberg Markets, shares of UBS up 5% in Zurich and in the U.S. on its latest earnings report, and its CEO telling Bloomberg that the company is gaining market share in the U.S. We've got highlights from that conversation. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for our stock of the hour, and it is UBS. The shares are higher in both Zurich and New York, trading by about 5% after the Swiss bank beat estimates last quarter, posting higher than expected profit thanks to investment banking revenue. UBS has also made progress in its integration of Credit Suisse. CEO Sergio Amati doubled down on efforts to return capital to shareholders through a $1 billion share buyback this year. Here's what he told Bloomberg earlier today.
I guess for the markets and for many investors, what happened early on this month has been a wake-up call, right? So, I mean, you look at the magnitude of the movements should make people think carefully about having a proper diversification and being very thoughtful about the way you invest money. So in that sense, the fact that we have basically made back everything within 1 week or two cannot be taken as a temporary issues. In my point of view, one has to really think that probably is a sign of some elements of fragility in the system.
But does it get easier as maybe we get a Fed cut, or does it get more complicated as we go to the U.S. election?
But look, when central bank cuts, it depends how they cut and why they cut. So if of course, there is now capacity probably to accommodate cuts based on lower inflation. But it's also, we need to watch exactly also what are the underlying economic drivers, and to the extent that the Fed is forced to cut more aggressively because of economic downturns, that would not really be good for the market. So we need to really watch why rates would come down and how quickly they come down. In general, we do expect and we see room for a potential rate cuts in the foreseeable future, but I wouldn't really be in the camp of predicting that the Fed will go as far as the market wants the Fed to go.
Why is that?
Well, because I think that probably the market is used to see central banks stepping in every time and being very accommodative in the previous cycles. And I think right now it's quite clear that central banks are focused also on inflation and therefore they don't have so much capacity to go as far as the market may want to see.
That was UBS CEO Sergio Ermotti speaking with our Francine Lacqua. Now, another stock that's on the move is Victoria's Secret, gaining after the company poached the CEO of Rihanna's lingerie brand to help in its turnaround efforts. Hillary Super will replace the current CEO on September 9th. Victoria's Secret has been struggling for years thanks to falling demand and increasing competition. Bloomberg Intelligence senior analyst Mary Ross-Gilbert has more on this. And Mary, it's clear that investors like the news because the stock is up almost 13%. What can you tell us about Hillary Super and what she's accomplished at Savage X Fenty?
Yeah, so Scarlett, thank you so much for that question. So with Savage X Fenty, she was just there for a little over a year. We don't really have any insight on how much revenues have grown. It's a very small business. Her beauty business is much larger. It's probably over 500 million, the beauty business, but from what we've seen and what we could find on the lingerie business, which is the Savage X Fenty, that's very small, probably under 100 million in revenues. But Super really has over 3 decades of experience. She was at the helm of the Anthropologie brand that's under Urban Outfitters. That's one, when she was there, it was over 1.6 billion. She's also worked at American Eagle Outfitters. That business is over 5 billion in revenues, and she was responsible for, she was an executive there, but she was not at the helm at that brand. But she has tremendous experience, and here Victoria's Secret is the largest in lingerie with a 20% market share, and has been really making great progress on their turnaround, and now I think we can get it back to growth.
Yeah, when we talk about CEOs coming in and really turning things around, I feel like Fran Horowitz over at Abercrombie & Fitch is kind of setting the bar on how to refresh tired 90s brands. What have you seen what will you look for from Super to see if she can do that for Victoria's Secret? Because she now needs to do what she did at Fenty, but at scale.
Yes, that's right, at scale. And she has that experience, and so that's the reason why they brought her in. So I think what we're going to see is, first of all, it's a woman-focused business, so it's really nice to see somebody come in like Hillary Super. And Martin Waters, who's the CEO who's exiting, he really has done a great job resetting the brand. It's highly inclusive brand, whereas it wasn't before. The business probably peaked around 2015 to 2018, and then it just really, it lost market share, 10 percentage points. So it was over 30% in 2015, and now, like I said, closer to that 20%. But now it seems to be stabilizing, and given that they've just reported earnings for the second quarter that are above consensus, and that happened also in the when they reported their first quarter preliminary figures, we're seeing improvement there. So I think she's going to really be able to take it to the next level and actually restore growth to the brand, because we've been seeing revenues declining. And it looks like market share is starting to stabilize. And of course, the fashion show is back. So we're going to have a new fashion show that was on a hiatus. They did do something different last year, more of a documentary type style. So it's going to be, I think it's very exciting. And when you think about it, Victoria's Secret has 76 million followers on Instagram.
Yeah.
And if you look at the Savage X Fenty brand, that has more like 5 million. So that just kind of gives you the difference in terms of the magnitude.
Yeah, that's really interesting that you compare it like that, because certainly that's the way that a CEO now needs to think. In terms of price points, and we're looking at images of the Savage X Fenty website, if you just take an ordinary bra from Rihanna's brand, it's about $59. Sure, it's lower if it's on sale. 2 for $29 here. But you look at Victoria's Secret's pricing, and it's about $15 or $16. What does that mean? How is she going to make that transition from something that's more high-end to something that's more mass market?
Yeah, so it's interesting because Victoria's Secret, the brand itself, is really considered more of a premium brand. So when you look at more of their fashion bras, like the Dream bras, Body by Victoria, those price points are probably more aligned. And then again, they will have promotions, but so when you look at that, it's really more of a premium orientation. However, Victoria's Secret did acquire Adore Me, which is the value-oriented brand.
Oh, okay.
And yes, and that is a digitally native brand, but it also comes with tremendous technology. This technology is a big opportunity for Victoria's Secret, and this is something I think Super will also be able to really take and accelerate that transformation in terms of bringing subscription services to the Victoria's Secret brand and also try on at home, something that's in test mode right now and expected to be rolled out, within the next few quarters.
Yeah.
So I think that's where the opportunity lies. So they do have, different brands, and they also have a marketplace. So they'll bring in, Victoria's Secret will feature clothing lines, and then bathing suits, and it'll be like different brands that they have there, and you can look online and you'll see them, so that there's a marketplace opportunity that could even go further. So when you think about the global relevance and how sizable this brand, and internationally, of course, they're growing in the double digits.
Yeah, I think you hit it on the nail, though, when you said the social following on Instagram was 79 million, and that's something that she can definitely focus on monetizing off of. Mary, thank you so much. Mary Ross-Gilbert from Bloomberg Intelligence on the CEO change over at Victoria's Secret. The stock is up about 13%. Coming up, why the world's largest steel producer is now worried about a potential crisis that could be bigger than the 2008 housing bubble. We've got the details next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. The world's biggest steel producer is sounding the alarm about a crisis in China with the potential to send shockwaves across the globe. The chairman of Baowu Steel Group is warning of a deeper industry downturn for the metal than the trauma seen in, say, 2008 and 2015, with conditions in China proving to be, in his words, longer, colder, and more difficult than expected. He described it as a harsh winter. Bloomberg Intelligence senior analyst Richard Burke is here. Richard, was this surprising to hear such frank comments, such a frank description?
I mean, it's probably surprising that there was a frank description, but I think the market kind of expected, given what we've seen over the last few, really the last year or so. You've seen exports from China go up markedly than it had in the past from previous levels. So I think the market may not have been that surprised. What may be surprised was the frankness of the chairman's comments.
Absolutely, especially from a company that's state-owned, owned by the central government. So he says the challenge will be worse than in 2008 and 2015. How do you read that? What's different about it this time?
Well, what's different is there's probably not a stimulus that the government can come in the past and stimulate the property sector. You know, the Chinese policy has changed to let's move more towards infrastructure, away from the property sector. And what has happened is in the past, in 2008, 2009, 2015, 2016, they launched a huge stimulus projects that stimulate the property sector. Yeah. And what happens is now we have an excess of property and buildings.
Yep.
Landowners aren't buying land, which finance the local Chinese governments. So local Chinese governments don't have money then to pump it into infrastructure and things along those lines. So that's the big difference.
Right, and it goes on, the ripples go on. Right. So in terms of ramifications for the global steel industry, and in particular the U.S. steel industry, how are you thinking about this? The U.S. Steel and Nippon Steel are still trying to get their merger approved. You talked earlier about rising Chinese steel exports. Is that what we're going to be contending with? How should the U.S. steel industry brace itself?
Well, the U.S. steel industry is probably one of the most protected markets there is in the world. That being said, we do have indirect consequences. For example, we've heard steelmakers complain lately about imports or exports from Mexico coming into the country. Mexico is part of our trade agreement, so why would that be a problem? Well, what the problem is it's not Mexican steel, it's imported from Vietnam.
Oh, I see.
That then
got redirected.
Has been redirected, but has originally started in China. So China has, basically transshipped steel to Vietnam. Vietnam ships it to Mexico, and now we have that. So the U.S., like I said, is probably the most protected market, but we've still seen implications flow through.
Yeah.
Where we're probably going to see worse
impact
is with Europe. Europe is probably the most susceptible to these imports coming out of China.
Yeah, we heard from ThyssenKrupp on Wednesday highlighting the challenges by reporting a big slump in earnings. Richard Burke, Bloomberg intelligence analyst covering the steel industry. Thank you.
Okay, thank you.
And I'm Scarlett Fu. That does it for Bloomberg Markets.